Hello and welcome back to the channel, and on today's video we're going to be going over everything ETF. And before we get into this video, I'd just like to say thank you to everybody for their continued support on the videos. We've just done our second giveaway on the 200 subscriber target that we've hit, and the next one will be at 300 subscribers, and we're only one subscriber away from that happening. So I'll be uploading 2 videos this week, so if you'd like to like, comment and subscribe to the channel, and everybody that comments on the videos will be in with a chance of winning on that next draw. So make sure you get involved, it is free. And again, thank you for the continued support, and I hope you enjoy the video. So whether you're new to the stock market or whether you're a seasoned investor, it can still be a very intimidating place. One of the best places to start when investing is with ETFs, in my opinion. It offers that blanket of security and a little bit of a safety net that individual stocks don't offer. So when you have an individual stock and it crashes or it burns, then it's done and dusted. With an ETF, again, they get refreshed and it's always the best picks of the stocks. So in today's video, we're going to be covering what is an ETF, why ETFs are great for beginners and long-term investors, fees and costs, what I personally hold, and final ETF tips. So what is an ETF? An ETF, Exchange Traded Fund, is a type of investment fund that is listed on the stock market just like individual stocks. It aims to mirror the performance of an index, sector, commodity, or various other assets. An ETF typically holds a basket of assets like stocks, the S&P 500, bonds, commodities like gold or oil, or a mixture of all of these in one ETF. It gives you diversification, low fees, it's easy to invest in, and it's much more of a hands-off approach. Why ETFs are great for beginners and long-term investors. So why can this be a great option for anybody that's new or a seasoned pro in ETFs? The reason being is for the set and forget and the hands-off approach. And what I mean by this is Trading 212 offer this option where it can be a back of house type job where you can set up a direct debit or an investment plan, and it can happen every week, every Friday, however you want it, every month, and you really have got to have that hands-off approach. Or you can just log in once a month or whatever your plan depends on being, but the important thing is that you have a plan, you have structure. The next thing is it's easy to buy and sell. Now, the volumes traded for ETFs are a lot bigger than small cap stocks, so you don't have a problem getting in and out of these within trading hours. That makes it very flexible and easy to buy into. Diversification in one trade. Unlike when you're buying one stock, when you're buying an ETF, you're exposing yourself to lots of different stocks and lots of different sectors, whether that's an S&P 500 or an all world. You really are diversifying across a lot of different companies. Great for long-term wealth building. So with a simple interest calculator and what you plan to have in place, you can see what it potentially could be later down the line or in the future. So whether that's 10, 15, 20 or 30 years, you could add in the annual income of that ETF on a rough estimation and see, and it really is eye-opening. It's less hassle. Being in ETFs is a lot less hassle than being in individual stocks. You haven't got to manage news half as much. You haven't got to worry about managing 10 to 15 different individual stocks, trying to dip your toe into everything. So it really is a less hassle, less stress, just one place where your money is, or a couple places, depends on which ones you choose to pick. And it really is a lot of a hands-off, less hassle approach. Some of the most popular ETFs that people tend to invest in is SPDR, which is for gold, Invesco All World, which is FTWG, Vanguard's Emerging Markets, which is VFEG, Vanguard's S&P 500, which is VUAG, and Vanguard's Bonds, which is VAGP. These are some of the top 5 ETFs that people do like to invest in. Why do fees matter? Now, why would fees matter? So here in this next slide, we're going to be showing 2 examples on why fees can matter over duration of time and why it's really important to pay attention to. So in this example, we're going to use Vanguard's All World, which is VWRP, and these guys charge 0.22% annual fee on their ETF. And we're going to use Invesco's FTWG for the exact same fund, but in their broker, and it's 0.15% for their fee. So this is just an example. So £1,000 a month for 10 years with 10% growth a year would be a final value of £199,268. After the fees have been paid of £1,873, which is 0.9% total in the 10 years. Invesco's is the exact same, so it's £1,000 a month for 10 years with 10% growth, giving you a final value of 199,864 after the fees were payable 1,277 at 0.6% total. Now this is the exact same fund, but you're being charged two different fees, and that's why it's very important. Now this was a okay example, but as you can see, it's not a huge difference. So people might go, oh, well, it's not that bad. There is funds out there that some charge up to 1%, which over the duration is a huge amount of money. So it's very important that you make sure you look into the fine print, make sure you look at the fees, and make sure you're getting the best bang for your buck, I guess. So there is no right or wrong way to invest when it comes to ETFs. It's all about personal exposure and where you want to put your funds into for a long duration of time. Myself, currently right now, I'm in an S&P 500 and an all-world fund. Now, I'm fully aware that gives me overweight exposure to the US market, but I'm 28 years old, and the way that I want to invest right now, I'm fully happy with that. Now, as you can see, over the last 5 years, the average annualized return for the S&P is 14.1%. And over the last 100 years, it's been an average rate of 10%. And the last 10 years, it's been 14%. And the last 20 years, it's been 12.3%. Now, the average return rate is about 10% a year off the S&P. Now, this is previous results, and it does not guarantee that it'll be like this in the future. But there's been more good than there has bad when it comes to the S&P 500. Now, the exact same thing for the all world. The last 5 years, it's up by about 12.5% on average each year. Last 10 years, about 10.9%, and the last 20 years, about 10.1%. Again, so they're both offering great optimal positions, and they're both doing well. And I wanted to make sure I was exposed to both of them, especially for the time that at the moment, the way I'm investing, I'm happy with this. As you can see from this chart as well, the all world does not outperform the S&P 500, but that doesn't mean that going forward in the future, this won't happen. And I'd like to, for the near future, keep myself exposed to both of them. ETF tips, maximising returns and minimising mistakes. This again is for educational purposes and not financial advice. Just some tips that might be able to help people along their way. So, timing the market versus timing the market. Timing the market, most of the time people don't win. Come up with a plan, stick to that plan, and stay in the market, whether it's a monthly deposit, whether it's a weekly, whether it's every 2 months, whatever works for yourself, but stay in the market instead of trying to time it for the lows, because you'll keep just missing out on opportunities. Keeping it simple. You don't need to be running around with 9 to 15 different types of ETFs that are overlapping and getting really confusing. Just stick to a couple of ETFs that you think are going to be good going forward and just run with these ones. What's your fees? So there's a lot of ones that I've shown in this video which have low, great fees, but there's also a lot of ETFs out that have really high fees. Make sure you're reading the small print. Make sure you're in reputable ETF companies, and keep your fees as low as possible. Don't chase past performance. Again, what happened over the last 100 years for the S&P 500 doesn't mean that it will happen for the next 100 years for the S&P 500. So don't be looking at past performances and thinking that that will happen again. We like to hope it will, and we do hope it does, but it doesn't mean it will. Use accumulating ETFs for simplicity. Now, there's accumulating ETFs and there's distributing ETFs. Distributing ETFs will pay you a dividend. Accumulating ETFs will reinvest that dividend in the background for you. Again, a more hands-off approach that keeps it nice and simple for most people. Stay consistent, have a plan. Now, back to some of the other clips that I said. Again, everything's about consistency and having a plan and making sure you know what you're doing instead of just winging it. So keep your deposits exactly how you like to, whether it's monthly or whether it's however you prefer to do it. And make sure you just stick to your plan. It's not an overnight success. It's about being patient and being persistent. And if you did enjoy this video, please leave a like, a comment and subscribe. And the Discord is down below in the description. And thank you very much for watching.